Welcome to the Deep Dive, the show where we take raw, complex financial data earnings reports, analyst notes, and really break it down into knowledge you can actually use.
And that is exactly what we're doing today. We are going way beyond the headlines for Gorilla Technology Group, Inc., that's ticker GRRR, and their third quarter 2025 earnings.
Right, because this one was fascinating. On the surface, you got this mixed signal that, honestly, it completely hid what was a huge strategic shift happening inside the company.
A huge shift. You had revenue beating expectations, but then earnings per share, the EPS, came in just a little bit light.
And normally you see that combination and the stock gets punished for it, but that's not what happened here. It actually went up.
Exactly, which tells you the real story isn't in that headline number.
Yeah.
It's buried in the operational details, the balance sheet, and especially the guidance for the future.
So our mission today is to use the 5-part framework from our source analysis, which really mirrors how analysts look at these things, to connect the dots. We want to see why investors were so optimistic.
We're going to walk through it step by step and see if this quarter really was, as the company claims, a major turning point. Let's dig in.
Okay, let's do it. Now for slide 1, the at-a-glance scorecard. So we always start here with the big headline numbers versus what Wall Street was expecting. Let's start with the top line, the revenue.
On revenue, it was a decisive beat. They reported total revenue of $26.5 million.
And the consensus estimate was what, just a bit lower?
The Wall Street consensus was sitting at $26.0 million. So, they cleared that hurdle by about $500,000. It's a solid signal that they're executing on their projects.
Okay, a solid beat on revenue. But then we get to the bottom line, the earnings per share, and that's where we get that little bit of a miss.
Correct. The adjusted diluted EPS came in at $0.24 per share.
And the street wanted $0.26.
Yep, just 2 cents shy. And a miss is a miss. But, as you said, the reaction is what tells the story. According to the data from MLQ.ai, the stock actually rose in after-hours trading.
Right, went up immediately, and that's the ultimate tell. When the market sees an EPS miss and just shrugs it off, it means investors found something much more important inside that report.
They absolutely did. They looked right past that 2-cent miss and focused on 3 things. The strong revenue number, the huge operational improvements we're about to get into, and critically, the very, very optimistic guidance for 2026.
So the market is basically saying, we care more about future growth than a tiny miss today.
They're paying for visibility, and Gorilla gave them a ton of it. And you saw the analyst community immediately fall in line. The initial consensus was a strong buy.
And a strong buy rating doesn't come from a 2-cent miss. It comes from analysts looking at that pipeline and seeing a credible path to huge growth.
It's them validating that strategic pivot to AI infrastructure. But let's ground that feeling in the actual internal numbers, the year-over-year growth.
Okay, so let's look at that. Total revenue, year over year, grew by a pretty substantial 32.0%.
Yeah, it went from about $20.05 million in Q3 of last year up to that $26.48 million this quarter. That's a serious growth rate for a company in transition.
And that growth didn't just happen on the top line. The bottom line improvement was, it was staggering.
It was. Looking at the official IFRS net loss, they improved that by 99.6%.
99.6%.
They went from a loss of nearly $8 million, a $7.78 million loss last year, to a loss of just $28,249.
Right.
They basically hit break even.
Which translates on a per-share basis to the IFRS diluted EPS swinging from a loss of 66 cents last year.
A painful 66 cents, yeah.
To basically zero, a loss of $2.
And that zero figure is where we really need to pause and drill down, because it's so important to understand the mechanics behind that number, especially for a tech company like this.
Okay, so before we unpack why it hit zero, let's do a quick explainer on the difference between basic and diluted EPS. It's fundamental.
Absolutely.
Yeah.
So basic EPS is the simple one. You take the net income and you divide it by the number of shares that are currently out there. It's a snapshot of today.
Right. But diluted EPS is the one that forward-looking investors really care about.
It's the conservative what-if scenario. It calculates the EPS as if every single potential share stock options for employees, warrants, convertible debt was exercised and turned into common stock.
It's the worst case for dilution.
Exactly. And for a tech company like Gorilla that uses equity to attract talent, you have to look at the diluted number. It shows you what profitability looks like after everyone gets their piece of the pie. It's the true measure of long-term value.
Okay, that brings us right to the core puzzle of this slide. The divergence between that soaring revenue and the break-even EPS. If revenue jumped 32% and they got to operating profit, why wasn't the IFRS profit, a lot bigger?
This is the hidden story. The answer is that their incredible operational performance was fighting against two major headwinds. And the first one was just a massive, massive amount of dilution.
Let's talk about that. Factor one, dilution. How bad was it?
It was almost a doubling of the share count. The weighted average diluted share count increased by an incredible 96.5% year over year.
Whoa.
It went from around 11.8 million shares to 23.2 million shares in just 12 months.
Okay, wait. A 96.5% increase. That means any profit you make is now being split among nearly twice as many owners. I mean, that's just brutal on a per-share basis.
It's a massive downward pressure. It means the company had to perform an operational miracle just to keep the EPS from cratering. And that's the point. That dilution completely obscured the second factor, which is how successful they actually were operationally.
Okay, so let's talk about that hidden success story then. Factor two.
So while dilution was hammering the denominator of that EPS calculation, the shares management was working magic on the numerator, the profit. The operating income swung from a $6.0 million loss in Q3 2024
A $6 million loss.
to a $0.4 million profit in Q3 2025.
That's a $6.4 million swing into the black on operations. That's the hard data that validates everything management was saying about strong project execution and being disciplined with expenses.
They didn't just grow, they grew profitably at the operating level for the first time. And that leads to the final confusing piece of this puzzle, the tax expense.
Right. The report shows a $1.44 million income tax expense. How do you have a tax expense when your final IFRS net result is a loss of $28,000? That doesn't add up.
It seems completely backward, but it's a key detail for anyone really analyzing this. It almost always comes down to foreign income taxes.
Meaning they made money in one country but lost money somewhere else.
Precisely. GRRR is operating globally. They likely generated that $0.4 million operating profit in a specific country, or several, that required them to pay local taxes on that profit, regardless of what the parent company's consolidated IFRS statement says.
So that local tax bill of $1.44 million then wiped out their small operating profit and pushed the final IFRS number to just about zero.
Exactly. The key takeaway is that the operational turnaround was real. It was strong enough to overcome massive dilution and a significant tax bill to still land at break even. That's the foundation we need to understand.
That makes sense. Okay, let's move on from if they were efficient to the quality of that efficiency.
Let's do it. Moving to slide 2, the engine of profitability.
So we've established they flipped to an operating profit by cutting costs, but now we have to look at the margins to see what this strategic pivot is actually costing them. Let's start with gross margin.
Okay, so gross profit itself was fine. It was $9.9 million, up a little from $9.5 million last year. But the critical number, as you said, is the margin, the percentage of revenue left after the direct costs.
And that number took a big hit. It fell from 47.4% a year ago down to 37.3% this quarter. That's a 10-point drop.
It is, and it tells you everything about their shift in business model. This is the cost of going from, say, a high-margin software business to a lower-margin, large-scale infrastructure deployment business.
Because building a data center involves buying a lot of hardware and paying for a lot of labor, which you don't have with pure software.
Exactly. Pure software can have 70, 80, even 90% gross margins. But when you're signing a contract to build an AI data center, you're buying servers, you're buying cooling systems, you're subcontracting construction. Those are hard costs that come right off the top.
So they're knowingly sacrificing that high gross margin for much bigger revenue numbers and to establish themselves as a major infrastructure player.
It's a strategic trade-off, scale over initial margin. But this is what makes the next part so impressive. Even with that lower gross margin, their overall operational picture got so much better.
Right. How did a 10-point drop in gross margin lead to a positive operating margin?
This was the key operational win for the quarter. It's why the market didn't care about the gross margin compression.
Sure.
We saw the operating income swing from that $6 million loss to a $400,000 profit.
So the operating margin went from a negative 29.9% all the way up to a positive 1.6%.
That's an improvement of 3,150 basis points. And it's almost entirely because of what they did below the gross profit line in their operating expenses.
They cut costs.
They slashed costs. Total operating expenses fell from $15.5 million down to just $9.5 million. That's a $6 million cut in overhead in 1 year while they were taking on more work.
That's incredible discipline. To cut overhead that much while you're scaling these massive new projects is the proof point the market needed to see.
It proves they can handle scale. And it makes this next part, understanding the difference between the official IFRS numbers and the adjusted numbers, so much more important.
Okay, let's get into it. The investor explainer, IFRS versus non-IFRS. Or, for those in the US, think GAAP versus non-GAAP. This is so critical.
Right. IFRS is the official by-the-book accounting number. It includes every single technical charge, every non-cash item. For Gorilla, that official IFRS net loss was, as we said, tiny, just under $30,000.
But then you have the non-IFRS, or adjusted number. This is management's version of reality, and it's what Wall Street bases its estimates on.
And this is where the picture changes completely. Management says if you strip out all the one-time non-operational weirdness, our real profit was actually $6.0 million.
A $6 million profit. That's a massive gap from the official tiny loss. How do they get there? What are they adding back?
Well, the reconciliation in the report makes it very clear. There's one single item that accounts for almost the entire difference. It's a plus $5.4 million adjustment for an exchange loss from currency devaluation.
And the analysis said this was mostly from the Egyptian pound losing value against the dollar. So explain why this is considered a non-operational thing.
It's a perfect example of a non-cash paper loss. Imagine Gorilla finished a project in Egypt and earned, say, the equivalent of $10 million in Egyptian pounds in January.
Oh.
But by the time they report their earnings in September, the Egyptian pound is weakened. So on paper, the U.S. dollar value of those same pounds sitting in their bank account is now only worth, say, $4.6 million. Accounting rules force them to report that $5.4 million difference as a loss.
But they didn't actually lose any cash. The physical Egyptian pounds are still there.
Exactly. No cash left the building. It's a technical accounting entry based on currency fluctuations. So analysts and investors look at that and say, that's not a reflection of their business performance, and they add that $5.4 million right back to the profit line.
Which gets you to that adjusted net income of $6 zillion and the adjusted EPS of $0.24 that everyone was focused on.
It's a much clearer picture of their true operational health for the quarter.
It absolutely is.
Yeah.
Let's move on. Now for slide 3, the engine room business segment performance. Okay, so we've confirmed the financial turnaround was real. Now we need to look at the real-world execution. The analysis says this part is more qualitative, but it's essential for judging whether their future growth promises are credible.
This is the ground truth. You can have great numbers, but if you can't actually manage the logistics of these massive multi-year projects, that $7 billion pipeline they talk about is just a fantasy.
Let's start with our main growth area, Southeast Asia.
The report says Gorilla is now executing its 5G and AI infrastructure projects. And, this is the key phrase, deployment activity accelerating.
Accelerating. That means they're past the planning stage and are actively building and generating revenue.
Correct. This is the engine that drove that 32% revenue growth we saw. They are turning contracts into cash.
Okay, what about the MENA region, the Middle East and North Africa?
The update there is that those projects are entering the final execution phase, which is also a very strong signal.
How so?
Final execution means they're close to completion. That de-risks those projects. It means revenue recognition is about to be completed, and it frees up key personnel and resources to focus on the next big contract.
The report also quoted management talking about strong collections and solid delivery momentum.
And that phrase, strong collections, might sound boring, but it's incredibly important. It means their customers, which are often governments or huge state-owned enterprises, are paying their bills on time.
Which isn't always a given with these kinds of massive contracts.
Not at all. Collections risk is a huge issue in this space. So strong collections validates not just Gorilla's execution, but the financial stability of their customer base. It all adds up to one conclusion. They've proven they can handle this stuff.
And that proof is what underpins the next slide, which for me was the real showstopper of the report.
Absolutely. Now for slide 4. Financial strength and shareholder rewards.
This is the part that took the story from a good operational quarter to a credible future growth story. Let's talk about the balance sheet. What was the total cash position?
The total cash on the books was $121.4 million. But the number we really need to focus on is unrestricted cash. That's the cash they can actually deploy immediately.
And that unrestricted cash number was $110.2 million. This is the number that made everyone sit up and take notice.
It's all about the magnitude of the change. The report calls it a massive and rapid accumulation of cash. Just compared to the end of last year, it's up 408% from $21.7 million.
Which is great. But the sequential number from the previous quarter is the one that's just mind-boggling.
That's the one. It was a staggering, almost unbelievable 990% sequential increase.
A 990% increase. What was the cash balance at the end of Q2?
It was just $10.1 million. They went from $10 million to $110 million in unrestricted cash in 3 months.
That's a financial earthquake, but I have to ask the critical question we discussed earlier. Where did that cash come from? Did they just issue a ton of new stock and dilute shareholders to get it?
That is the right question. And the analysis suggests no, that's not the primary driver here. While there has been dilution over the past year, this massive sudden cash infusion is seen as evidence of milestone collections from their big projects.
So they hit key delivery targets and their clients paid them huge sums of cash all at once.
That's the interpretation. Their business model is working. It's not just a dilutive capital raise, it's monetization of their work. And on top of that, they were also paying down debt.
Right, their debt position improved too.
Yep, debt was reduced by 30%. It fell from $21.4 million down to $15.1 million.
So you have a massive cash injection and you're paying down debt at the same time. That's a picture of incredible financial health.
It completely changes their strategic position. The CFO, Bruce Bauer, said it perfectly. He said their capital structure now is strength, not a constraint.
Before, with only $10 million in cash, they were constrained. They'd need to borrow money or find partners for any big new project.
And that costs money and time. Now, with over $110 million, they can self-fund the initial stages of huge projects. They can provide financial guarantees to governments. They're no longer a small player hoping to win a contract. They are a well-capitalized partner.
That cash is the key that unlocks the credibility of their entire future pipeline.
It is, which brings us perfectly to the final section.
Finally, slide 5, the road ahead management's outlook and key takeaways. Okay, this is the payoff. All the operational discipline and financial strength we just discussed is what makes this outlook believable. Let's start with the CEO's big statement.
The chairman and CEO, Jay Chandan, he didn't mince words. He said the third quarter marks a turning point where GRRR became a recognized leader in AI infrastructure.
That's a bold claim, but after seeing the balance sheet, it suddenly has teeth.
It does. And he drove that point home by taking a shot at the competition. He said GRRR's contracted projects, strong balance sheet, and clear line of sight to scale differentiate us from peers that have yet to deliver beyond the promise of AI.
That's a great line. He's saying, while other companies are selling a PowerPoint deck about AI, we are actually building the data centers that make it possible.
It's the difference between hype and hardware. And right now, the market wants hardware.
Okay, let's get to the numbers. The guidance. They kept their 2025 guidance the same.
Right. Reiterated full year 2025. Revenue between $100 and $110 million. Adjusted EBITDA of $20 to $25 million.
No.
And that wasn't the main event.
No, the main event was the new guidance for 2026.
This is what sent the stock flying. For 2026, they are forecasting revenue in a range of $137 million all the way up to $200 million.
$200 million? That's a massive jump from 2025. What gives them the confidence to put a number like that out there?
It's not speculative. It's based on a signed, secured contract. The guidance is underpinned by the first phase of their new $1.4 billion AI data center project in Southeast Asia.
$1.4 billion.
And that single project, just that one, is expected to contribute $100 million in annual revenue from 2026 all the way through 2028.
Okay, so that one contract provides a $100 million baseline of revenue for the next 3 years. That makes a $200 million forecast for next year seem entirely achievable.
It provides a floor for their valuation. It gives analysts incredible visibility. And remember, that's just one project. The company says their total pipeline of other opportunities is now over $7 billion.
Before this quarter, a $7 billion pipeline number would have sounded like a joke.
It would have been dismissed as pure marketing hype. A company with $10 million in cash can't credibly chase $7 billion in projects.
But a company with $110 million in cash and a proven track record of execution.
Now, the market takes that number seriously. They've earned the credibility.
Let's tie it all together then. Key takeaways. We started with this confusing headline, a revenue beat, an EPS miss. How should we reframe this quarter now?
It was about proving capacity. The 2-cent EPS miss was just noise, completely irrelevant. This quarter was about validating two things and two things only.
First, operational discipline.
Yep. Proven by that swing from a $6 million operating loss to a profit. They showed they can manage costs while scaling complexity.
And second, financial capacity.
Proven by that fortress balance sheet, going from 10 million to 110 million in cash.
Yeah.
That's the war chest they needed to go after these mega projects.
And those two things together are what make their future guidance credible. The market's positive reaction makes perfect sense now. They saw a company transforming into a well-funded, large-scale infrastructure powerhouse.
Exactly. Without the proof on slide 2 and slide 4, the promises on slide 5 are just empty words. This report showed the foundation is rock solid.
So here's a final thought to leave you with. The big challenge for GRRR isn't winning contracts anymore. It's what comes next. Now that they're building all this infrastructure, can they pivot again to selling the high-margin software, the maintenance, the AI services that run on top of it? That's how they get that gross margin back up. That will be the story to watch over the next 2 years.
That's absolutely the next chapter. The hard build-out is underway. The optimization has to follow.
Well, this has been a fantastic deep dive. It really shows how you have to go past the headlines to find the real story.
Before we sign off, we do need to provide our standard disclaimers. This report is for informational purposes only. It is not and should not be taken as financial, investment, legal, or tax advice.
All investment decisions you make should be based on your own independent research and always in consultation with a qualified financial professional. We're just here to analyze the data.
And finally, a reminder that this report was generated by an artificial intelligence model. And while it's designed to be as accurate as possible, all of the information we discussed should be independently verified by you.
Like and subscribe to stockanalytics.ai YouTube channel. Members get access to our library of S&P 500 stocks and NASDAQ 100 library we are building out, and also get priority requests for company deep dives.